Thanks everyone for joining. Look, I'll kick off with just a little background on Wrkr and where we play, and then we can get into the meat of it for those who know our business, and hopefully plenty of time for Q&A. Obviously, there's all of this research yourself, but we are Sydney based, but our teams are based in Sydney and Melbourne, about 42 people, and we're 100% onshore, so Australian based software engineering company. Sitting around the 40 mil market cap, and sitting in the direction towards now EBITDA positive is where our current forecast direction is. Let me jump in, and just a couple of quick facts. This helps people understand who we are and how we're building as a business. But product mix for our business is actually, we have a good balance. They're connected products, so many of our customers take multiple of our products, but the onboarding compliance moments for new hires, through to pay and super processing, through to license credential checks, but most importantly, all of the compliance and lodgement between the ATO behind the scenes. That's the mix. We are predominantly SaaS and user transactions, small amount of float, interest income, and license. We do have services revenue in our business, but those services revenues are predominantly pre-implementation fees before large organizations go on to SaaS licenses per user. So today we sit around 5.2 million of our revenue, of our around 9.5 million revenue. We sit around 5.2 as our ARR, so what I like to call the good revenue. We run at an ARPU, average revenue per user, of around $7. And of our direct users that fit under that profile, today we already serve about 500,000 users. Although our software actually extends broadly in the market, we touch about 2.9 million Australians, 2.9 million TFNs, tax file numbers. So, we're certainly on the grow. I'll leave you to do your own maths, but our entire focus in the business is growing those direct users through channel to operate at that 7 to 8. We're trading at $8 ARPU, but we have a target benchmark of 7 and growing. So that's really the key background, the way to look at our business. Let me start with, so what is our business and what do we do? Well, the main problem is, well, for Australia, and I think every one of you has either worked in the role or you lead a company and you've had to deal with it, but the compliance complexity for both hiring an employee and paying an employee is just going up and up and up in this country. Has been doing so for years, and that is compounded by, obviously, we're then also transiting an enormous amount of PII or sensitive personal data, and potentially putting employees at risk. So that is putting pressure on the system for the requirements of quality software to underpin this. So specifically for hiring an employee, identifying them correctly, making sure they've got a right to work and what the constraints are, TFN checks, tax declarations, and the most complex actually is the super choice moment. I'm going to talk a bit about that today because that is the bread and butter of our business. Just to give you a little insight, by law, every company in Australia is obligated, when they hire a new employee, is to staple them, so give them the opportunity to select their existing super fund or make a choice. And if they don't choose either of those, they can select a default, and you're also obligated to provide a default. The management of that process has to be recorded, has to be clear, and today it's done by one click into the ATO. It's not one click, it's log in through your as an RM, do a one at a time TFND search after you've done your Gov ID, and that sounds great if you only employ one person a year. It's pretty tough if you're a major supermarket putting on 28,000 people. So that's on the hiring side. The complexity is actually quite high, and you require the technology behind it isn't just great digital tech. It needs to be integrated into the system, which Wrkr does. On the right-hand side, which is paying, pay processing, paying disbursements, paying super contributions and moving that money and the information along the SuperStream network, single touch payroll reporting, and then the reconciliation. To enable that, a business needs to have a particular AFSL, which is the AFSL for non-cash payments, and be a GNGB gateway or clearinghouse, of which there are only 9 in this country. And Wrkr is one of those, and our licenses and software underpins another of those in the country. So two of the 9. So core for us, Wrkr sits where, the way I describe it is, it's an iceberg, and we sit below that iceberg and move the most complex of those transactions. They're very high volume, high complexity, but it creates for a very large moat around our business. So who needs these problems solved? Well, the good news for us as a company, the pyramid really represents who has the largest proportion to solve that problem. But super funds today move the most amount of super contributions on behalf of employers, and I'll talk a little bit about that in today's presentation. They are our largest customer group, in the market. Payroll providers outsource this work, particularly around the super contributions movement. Small business owners, HR system providers, all the way through to up to employers who choose to do it directly. So it's a relatively unknown problem unless you're sitting in as a CFO or in payroll or HR, or you've had a tap on the shoulder for failing to meet your obligations. The fines are onerous. It's expensive and reputationally difficult. So people look to strategic partners such as Wrkr. So that's the background of who we are. Couple of little things to share. The way we operate is we leverage. The key to this is a mobile experience for the employer, so the employer can participate in their own data, an employee, in the brand of the employer, but the contributions being passed and processed and paid for at a contribution level by the super funds. So it's a complex ecosystem that we've developed our technology to navigate. So effectively, we sell to one large channel client, a super fund, but that actually enables us to reach a large amount of employers. If I take a typical industry fund, is touching and servicing up to 100,000 employers, up to 1 to 2 million employees. So it's a very fast pace to market once you've integrated and built the solution in. Obviously, where we go direct, though, the key for us is bringing this together, and partners, other players, and their compliance moments into a one-stop shop for organisations. So that's the context of our business. I'd probably want to, before I jump into the detail here, so I give you that as context because not many people even realise this is a large challenge in the market. We see the challenges in bite sizes. So Wrkr really is on a mission. We're fairly single-minded about it, and that is to transform the employer to employee compliance experience. Today it's poor. It's either done on paper, it's done through multiple providers, security standards are suboptimal, and people are struggling with the trade-off between a good experience to onboard an employee and meeting the obligations. So you can't cut corners. So how do you achieve both? That is the mission for our business, and that is really what's been the backbone of our success. That transformation, we are starting with the transformation of the superannuation industry. These are the largest organisations in Australia, from a singular reach to members, and most certainly very influential in this underpinning of standards. So to achieve that, we've worked very hard to partner with, they were known as the Link Group, now MUFG Retirement Solutions. So apologies, I'll alternate I still haven't quite got it in my mind from Link to MUFG. But as an organisation, we have partnered with them to take our solution and technology, provide it under a SaaS license to their clients. Now, we're very fortunate in two things. One, it's been a substantive co-investment between both MUFG and Wrkr to both develop additional features unique for the industry fund landscape, to prepare the platform to really deal with two new changes one that's already arrived in stapling that I'll touch on, and that I mentioned a little bit before, and payday super that I'll touch on at the end in 2026. So we've invested heavily. We've integrated the platform into their administration platforms, contact center and support, infrastructure, processes and talent, which has now positioned us to roll this solution out to each fund that wishes to adopt it in preparation for payday super. That is a major effort, and to be honest, for a small business, we've grown at a fantastic rate, but we've been bootstrapped because we've invested every dollar into driving out to this position. And so what that really means is we build a core platform as I've just described, but the why is fairly key. When I look at MUFG, they really represent some of Australia's largest super funds, some of the most prominent brands that have some of the best reach into the employer network. So they provide and process contributions today, of which that is our target market in step one, is to take over the processing of those contributions and onboarding of members. And their current client list is Australian Super, Rest, Hostplus, Cbus, Hester, and a variety of others, some 7 million contributing members. So that is our pathway to the 14.5 million full-time employees in Australia, of which about 19.4 million jobs. So some people are working harder than others with multiple jobs. But of that target market, this is our trajectory and why we've been investing, because our target is to reach half of the working population of Australia. That's where we're going to continue pushing this business towards. And we're very proud of what we built underneath to make that a possibility for the business and our shareholders. So the MUFG contract is really our number one focus right now in delivering this value and technology. So that's really the background, the core of the business. And I talk about super because, well, one, it's ubiquitous. The government have mandated it across Australia. It continues to grow as it ratchets up to 12%. But it's also a very complex service to provide, with many players having to participate. So having us sitting underneath and managing the movement of money, the movement of messages, the movement of data and information, and the movement of members into that system, having one capable supplier able to deliver that across a large volume, obviously will open up an enormous amount of possibilities beyond the super for our business. So that is the core. So where are we headed? It's probably worth touching on our financial highlights. So while bootstrapping our way, we've just come out of our 4Cs recently. Some of you may have sat in on the quarterly, so apologies. This may not be news for you, but we're sitting on operating cash flows performance in that last quarter, which were significantly up. So a positive 340K, up 190% on when compared to the year before. And that's true of nearly all of our metrics. We have been up quarter on quarter, year on year. This is that positive net cash flow really achieved for the first time in the company's history. Wrkr has only been the new brand over the last 2 and a bit years, post a merger 3.5 years ago, nearly 4 years ago now. I'm getting old. But in the entire history of the company, this is the first positive cash flow. Partly driven a real commitment. We continue to drive costs down you'll see the cost to income ratio still improved, even though we've been very cautious with cash. Cash receipts, 9.1 million, up 46%. And that trend is really a growth in our SaaS underpinnings, very high retention. We sit on our major contracts and a 100% retention. Our largest single platform contract we just recently announced, that's with Australian Retirement Trust Precision, their administration business inside for Beam. That software license we recontracted for a further 2 years, so extending on with a 25% uplift. So across the board, we're pretty proud of the fundamentals. The historical financial results, I think some of you may have seen this before, but the trend line is fairly clear. We've been growing, at around the 40% or higher. That's easy to say when you're off a low base. We intend to continue in that direction. The next 12 months is a large opportunity in front of us. So we will likely drive far more investment into implementation to bring a larger volume of SaaS revenues forward. Just to touch, I'll touch on that when I talk about Payday Super. But as you can see, the trend lines continue to grow. That's a projection on FY24, but we're fairly comfortable with where we're landing there. So I think some of these, we have targeted a positive EBITDA for 2025. In our view, we've worked very hard to get close to that. We'll wait and let the auditors do their work for FY24. There's the big key change on the financial outlook and the regulatory tailwinds is really Payday Super. So to date, it suggests that July of 26 is the start of Payday Super. What does that mean? It's a small, one would think a small change. It is an enormous system change for the super landscape. And that is the government mandating for all companies superannuation to not be paid quarterly or monthly if you're over 3,000 employees. It must be paid in sync with your pay. So when wages are paid, super gets paid. And this is because there's a little over 2 billion in unpaid super hanging out in the ether. The government is the funder of last resort on underpaid super. So they have a mission at Treasury to bring this system and remove fraud and risk for Australians. But what does that mean? Well, that means for any company that is currently processing their super contributions, they need a significant uplift. And that's really the opening door for our organisation and what we're focused on over the next 12 months. So 24 months out from 23 months now, as at today, 23 months out for large super funds, HRM and payroll systems to really upgrade where they're at to be able to enable that Payday Super. And it's not just the processing of cash, it's the ability to remove the errors within a week if you're paid weekly rather than having a quarter. And that means the shift towards a different technology mindset. So that's really the core of what's going on in our business. But I did rush through that because it's recorded and you can go back, but I'd rather get into some Q&A and talk about, I'll leave this on the screen, but maybe Mark, good opportunity, we can just jump in.
Yeah, maybe if you just want to tab to the next slide, Trent, and we leave up that Investor Hub details. Yeah, there we go. Yeah, just a question from me in terms of, you talked about the two sides of the business, new employees joining a business versus, the ongoing paying of somebody every month. Is there a major kind of profit margin difference between them? Are you like agnostic? Are you, is it better for you to be taking on a client that, is hiring lots of people and growing, their business as opposed to maybe, somebody like Coles who, they're hiring, people are leaving, but, essentially it's the same. I don't know how many people Coles have, like 20,000 people, every month that are getting processed. Maybe just talk to the two sides and how it affects margins.
Yeah, we tended with the big contracts build it into a flat SaaS fee. So we like volume, there's no doubt. However, where we sell direct into the market, so employers buy directly off us, the onboarding is far more profitable. And I mean, to give an example, it's the combined compliance moment. So we are, in the complexity of navigating, say, the chemist environment. It's not just onboarding an individual, it's APRA medical checks. It's we process and they select, their contract is agreed to, and the contract policy elements help define the actual role, which then feeds into payroll for accurate pay. So that's in that area, it's a much higher risk for an organisation, so our return is higher. But where we go to market with the super funds, we build it into the flat price. So we love a Coles coming on board. Coles would benefit greatly because they have a higher turnover rate, for sure. What's unique though is probably different to other industries. We like the industry funds because they are the highest moving employees, and although probably on average the lowest paid, because it's a lot of first-time employees, first-time jobs. For us, the transaction income is the same, whether I'm doing it for the CEO of a multinational or somebody who's having their first full-time job packing shelves in Woolworths. It makes the same for me. In fact, it's better because they'll be paid fortnightly. So that's 26 transactions versus 12 monthly transactions. Yeah. So yeah, if that helps.
And that helps. And then, yeah, just on the industry funds, I think we talked about this when you were presenting at the live event back in Sydney on. There was a question, I think it's worth going back to it again, only because I'm a member of ART, and I see now we're merging with Telstra, which we previously had merged with Q Super. When I started, it was Sun Super. So, I mean, that is another big push from whatever, government, treasury, APRA, ASIC, to narrow down the amount of super funds in the market. So maybe just the flow-on effects for Wrkr of these super funds just becoming a smaller and smaller number, but the scale is just becoming huge.
Correct. I think we won't see a total consolidation because there are some smaller funds that are very high performing. So it's really about performance is what the regulator's trying to drive down, move out non-performing or subscale. But you're right, at the total number is definitely shifting. It'll shrink. And the key is making sure you're in the large funds, which are more likely to be the net acquirers. So, for us, providing Sun Super was, so I'm glad you say Sun Super, Telstra. Sun Super was our first major super fund client. And as we helped them build Beam, and we still license our technology into that, well, Sun Super merged with Q Super. Beam has remained the dominant force as they picked up 3 or 4 additional funds. Telstra, like Qantas, a couple of others. That will all continue to flow in, and that will be a net positive for us. So who you get in, where your footprint is in the next 12 to 24 months, I'd say 24 months, is really going to define your positioning in the market under any level if the market continues to concentrate. Those big industry funds that we focus on, and why we focused with MUFG, we see them staying as large dominant players and more being the net growers than the other way, because they have such a prominent position. So yeah, it's playing into our hands, but it's definitely going to make it tighter for new entrants.
Yeah. And then just the kind of to play devil's advocate on that then is, obviously with more members, when the SaaS contracts and renewals come up for discussion, they've got kind of more pricing power. And then, how are you thinking about navigating that, or have you had those conversations where they're kind of, trying to push down the fee because, oh, well, the last time we put this in place, we had 1.8 million members. Now we're on 2.4.
Yeah, yeah. Well, look, and so for us, contract terms are typically a 3+3+3, so 3 years plus the extensions. CPI are typically built into our contracts. So we're going up even if we get squeezed to come down. We're not coming backwards from where we are. There's a genuine cost to deliver services. I think the second part is there is increasing complexity. And so one of the areas we've focused very heavily on is the security and the cybersecurity side. And that's an increasing field. So if you can keep your prices low, and we're talking $7 ARPU per member, if a member's paying $7 a year to ensure that their data is secure, they can have a digital interaction, there's rich information about them, and their contributions are flowing accurately and being reconciled, it's a pretty low cost when you break it down to a weekly or a monthly, right? So we've stayed low. We've come in hard to cut this market hard because we believe we built an efficient model, right? So that's one. I think the biggest though is the partnership with us. When you roll this out, it's using our AFSL. We're doing the director consents and the direct debit pay. We are the payment processor. So to swap us out, the last time the super funds did this was really when they built the system in 2009 to 13. So this is really us coming into the market now and the work that we're starting to underpin. It's a first major change. We're not expecting them to change again because there is an impulse to your customers to go out to businesses and say, we've got a new system underneath us here. We want to train you in that and we want you to use it. So that's once you're in, the moat is deep and wide.
Yeah, and especially with, payday super as well is, from a compliance standpoint, one of the biggest changes we've seen in a long, long time. I just want to draw people's attention before we wrap up here. If you look in the chat now, I've uploaded the latest RaaS research report that came out after Trent released the 4C last week. So if anybody wants to download that, you can grab it in the chat, or for anybody who's following along online on YouTube, it is available on the RaaS research website. Trent, thank you very, very much. We're just about up on time, and I do see our next presenter is joining us. So yeah, hopefully we can get you back in maybe later on in the year.